this is an and asset. We get to put our money here and we get to go do other things with it. People think, oh, well, I can't do that. It's an or asset, which is what an IRA is, a 401k, a Roth, whatever. No, you can still use this to put it into your investment. I don't care if it's real estate. I don't care if it's an IRA. I don't care if it's a brokerage account. Does not matter to me. I had a guy I talked to this last week as well. And he's like, Mary Jo, I'm going to come into like a boatload of money. And he's like, so I can get a better return outside the policy. But it would be smart for me to run it through the policy, right? And then borrow against the policy and go put it in my investment. I'm like, yeah. Because if you run it through the policy, we create a death benefit. That death benefit is massive. For what he's doing, the death benefit is super important because then if he dies, it goes back into this huge conglomerate of business opportunity that he's doing. Fantastic. Now he just made that opportunity bigger for his family. Hello, and welcome back to the podcast. Thank you very much for being here. The new studio. How exciting. And Tarisa's in town just for the new studio.
Yay. Not just for the new studio.
Right. She's here to visit as well. But we're going to work at the same time. So this is exciting. The studio just was finished yesterday. And so this is all 100% new to me. We're going to do batch recordings because she's here from Arizona. But we'll see. Hopefully we don't do a bunch of recordings and they don't turn out because that would suck. Okay, so we are going to go over the one thing that I really want to touch on with Tarisa being here is Nelson's book and really go over all those chapters and break those chapters out and talk about all that stuff. So that's what we're going to do.
Let's do it.
Your flight in was good?
Yeah, it was great. It was fantastic. Except for there was a gentleman that had a bloody nose that did not wash his hands. So,
Tarisa's a germaphobe.
Well, if something's coming out of your body, no one else should have to be subjected to it.
True. Very, very good point. Okay. We are not germaphobes around here, but I would have probably not even thought about that, honestly.
Really?
I'd have been like, oh, he's got a bloody nose. That sucks. How can I help him?
Well, I tried to help him, but also I was like, wash your hands.
Did you have some hand sanitizer to hand over?
Well, there's still blood on it. Doesn't get rid of the blood on his hands.
I truly probably would have not even thought of it. We are not the same. All right. So we are going to go over, we don't have any fun facts because we got a lot of stuff to do. So we're going to get right to it. So we're going to go over the introduction and we're going to go over points to consider. If you guys do not have Becoming Your Own Banker, I say it all the time, why? You need to have this book. This is truly what we study from and what we're looking at. And so if you don't have it, go get it. Or if you have it, go get it and study with us. Go through the book with us because there's a lot of objections that people have that are answered in here. And a lot of these objections are going to come out just in this first chapter. Okay. Introduction of the 5th edition. Do you also have the 5th edition? Okay. So the first, and I really want to break this down by paragraph.
Okay. Let's
because we have, which means I gave my readers. I want to break it down by paragraph because it really is that like everything he says in this chapter is that important. So my new chairs are a little bit big. All right. So it's in the very beginning and we'll just maybe swap chapters.
Yeah.
Or swap paragraphs.
Perfect.
He says the infinite banking concept is a 10-hour course of instruction about the power of dividend-paying whole life. It is not a sales tool for life insurance agents. It is education that the life insurance industry should have taught over the last 200 years. Ironically, life insurance companies must put premium in income to work in various investments in order to pay death claims. So there's a lot there.
There is.
Like a lot. And you guys, I have a little wiener dog. There she is. She loves Tarisa. So, you are You are meet the wiener, aka Winnie. Nobody calls her Winnie. All right. So this is a 10-hour course in dividend-paying whole life, not a sales tool for agents. And so the thing that I get out of that is it's a teaching tool. And there's a lot of agents that want to use it to sell. And a lot of those agents are not infinite banking authorized, right? They're just going to go out there. They're going to sell some insurance. Be like, yeah, I can do infinite banking. I know what you're talking about. Do you?
Right.
Do you? Because I have my doubts. Right. He also says in here that the life insurance company should have been teaching this over the last 200 years. So when people say, well, is this new? No, it's 200 years old. It's just that life insurance companies haven't taught it for the last 200 years. And then he says premiums are put to work in investments to pay claims. So we get this question a lot. Where does a life insurance company put their money? What do they do with it? They put it to work so they can pay a claim. A lot of people do not understand that it takes anywhere between 13, I believe, to 15 years for the insurance company to have a big enough return on that premium to pay that death benefit. And so when they're doing underwriting and they're being super picky about your health, it is because they don't want to take the risk that you're going to die before they make enough money to pay the claim. Because it's not a one-time premium. You don't put premium in one time and then they can pay that claim. We've taken that premium and we've stretched it out over your lifetime, and now we want to be able to pay that claim.
So basically, like the longer the contract goes on, the more they're mitigating their risk.
Correct.
Yeah.
Yep. And then people will say, well, they're making money. Are they making money, or are they just being smart to say, hey, I have to make money on you and I have to make money on Mary Jo. And if one of you dies early, we have risk there. And so, yes, they're in the business to make money because they have claims to pay.
Well, also that's why like the underwriting process is so important, because they are signing on to have you as a part of their book of business for your whole lifetime, right? Which is a huge commitment. Like a mortgage is 30 years, life insurance is until age 121. So it's good that they're taking the time to make sure that they're mitigating their risk and making sure that they can pay the claim, they can pay they're taking all those things into account, and they have to plan to remain in business for hundreds of years.
And this is also something that I think it's worth pointing out, that it's just like when you get universal life or variable universal or indexed ULs, it's less premium. And the premium may be less just because of the fact that they're like, oh, I know this isn't going to go to age 121. I know that the fees and all that stuff is going to eat it up beforehand. So we don't have to worry about it.
Right. It's going to lapse anyway.
Right.
Sort of situation.
Yeah. So they're not taking as much risk as dividend paying whole life.
Yeah.
So that's a lot. I guess one paragraph.
That's one paragraph. Is this section, and I like this line, unfortunately, the industry has concentrated on the death benefit qualities of the contract and has neglected to adequately describe the financing capabilities that it presents for the policy owners. So even right there, like I think so many times in having conversations with clients, it's like they can't get over the fact that this is life insurance that we're doing this with. But it's like Nelson is saying right away that we're not focusing on the power of the financing capabilities of this tool because we have only been looking at the death benefit.
And they haven't told us that. How many times do we see a client and they're like, oh, I have a whole life policy. I didn't know, my agent never told me that I could borrow the cash value. Like some agents may not actually know.
Right. That's
because of how what they've been taught, right?
Yeah. Okay. So some of my favorite lines in the second paragraph are, this book demonstrates that your need for finance during your lifetime is much greater than your need for protection. Solve this need through this instrument and you will end up with more life insurance than the companies will issue on you. I'm just going to read this. So I highlighted the whole thing. Most everyone is familiar with the fact that one can borrow from a whole life policy, but because of how little premiums they pay, there's limited access to money to finance major items needed during a lifetime. Yet the need for financing for the typical person is extensive. So he packs so much in there. Basically, what I wrote down is like, everyone needs money to live. Like, that is your sister, your brother, your mom, your dad, your kids. Like, that is a universal fact at the moment. Like, you need income to live. And what he's saying is that your need for finance is so much greater than your need for protection. But if you solve your need for finance through this instrument, you will end up with so much more death benefit than the life insurance company would have ever approved on you in the first place.
Mm-hmm. And you actually missed like one of the big pieces, the very last sentence. Really, all this book adds to the equation is scale. And so we're saying, hey, how much money can we put in as premium? Because we can borrow it back right away. So how much money can we put in as premium? That if we're funding it correctly to put the majority of our money through for major assets, which we'll get to in another chapter, we are going to create more death benefit than any life insurance agent would have sold you anyway.
Mm-hmm.
And so your life insurance agent, and it's so, again, something that's super funny to me, is when another life insurance agent says, oh yeah, I know what they're doing. And then they come to me and their death benefit is an even dollar amount. Oh, it's $1 million. I'm like, that is not how we do it. If that is clear, right? Done. Case closed. They have no idea what they're doing. Because when we're selling life insurance, we're saying how much premium can you put in? And it's going to buy X amount of dollars of death benefit.
Yeah, it's almost backwards.
Mm-hmm. I just did one the other day that they had a lot of life insurance. And I thought, oh, we'll see if I actually replace it. Because I don't want to replace with less, right? We want to make sure. They wanted to 1035 their money into a new policy. So I wanted to make sure I'm not going to leave them with less death benefit. And there was more death benefit there, the way we do it, than the way they had it anyway. And they had a significant amount. But we were solving for their need for finance.
Right. Because to them, what was their first question? Like, how much do I have access to in the first year? Or like, what were they planning on using their policy for?
So in this case, they farm. So they had pivots. And their insurance just on their pivots was $30,000 a year. And they're like, that's crazy because our pivots are super maintained. We don't have to fix them a lot. And pivots are very expensive. So they're like, why would we not just self-insure for that?
Mm.
And because if we ever have a claim, then the insurance company raises our premium anyway because there's a claim. And so they're like, we may as well just self-insure. So in, a few years, they're going to create this pool of money that when they do need a new pivot, if something happens, a storm goes through, whatever, completely demolishes it, a tornado really is probably what would have to happen, then they'll be able to just buy a new pivot by borrowing cash value.
Without having to
And
get,
so
like,
when we
approval.
took $30,000 a year and added that into a new policy, we're solving for their need for financing, but their death benefit then ended up being huge.
The death benefit is really important. Like, I don't want to miss that fact.
It's very important.
But the main issue we're solving for is their need for finance, their need for access to cash.
And Nelson didn't say the death benefit's not important.
Right.
He said our need for finance is so great that if we use the concept, we will have more death benefit than we would have normally had. So do we look at it? Yes. Is it important? Yes. But it kind of rides along. Like, there's a lot of times we're over people's human life value. Mm-hmm. So the insurance company says you're worth X amount. It's 30 times, 20 times, 15 times, 10 times your gross income or 1.5 times your net worth. A lot of times we're over that. And so then we're like, well, now what do we do? We're over it. So now we got to go find somebody else to insure.
Mm-hmm. Basically what he's saying is like, we're solving for this problem, but you're going to be better off than you were in most regards with financing and with your death benefit by implementing this process.
Okay. Third paragraph is the fact that the principles have been there all along and no one taught them makes me rather angry. Someone should have recognized them and taught them long ago, but it didn't take place because the mindset that predominates in the entire financial world. And that is so true. How often do we hear, well, our financial advisor never heard of this? Of course they didn't. They're not teaching it at school, right? Like it just, or Uncle Susie, Uncle Joe and Aunt Susie haven't heard about this, right? So we shouldn't be doing it because they haven't heard about it. Why haven't they heard about it? I don't know. Because the insurance industry for the last 200 years did it wrong. You know, it's always been there. It's not new.
Yeah.
But it is definitely not normal.
Because of the mindset that predominates in the entire financial world, what he's saying is like, predominantly, most people are not going to be able to wrap their head around this. And I think that you and I find that to be pretty common because it requires you to unlearn what you've been taught about money. And that is harder. Unlearning something is harder than learning something new.
Yes. We're having to unlearn what they have done in the industry because they've taught us what they wanted us to know.
That's a really good point.
When you have kids that are going to be at the age where they're going to they're going to school and they're going to be taking finance classes and those sort of things, right? I made Haley she did not want to, but I made her take the finance class. I'm like, I want to know what they're teaching. And they're teaching everything they want us to do. 401ks, IRAs, go to the stock market. They're not teaching cash flow. They're not teaching how to control your own system, how to control your own money. I had a meeting with somebody last week and they said, Mary Jo, is there a homeschool course for this? Because Dave Ramsey has a homeschool course.
Oh, that's interesting.
And so she's like, all these kids at homeschool are learning just to be debt free. They're not necessarily learning about cash flow. And money management is super important. Super, super important. But so is cash flow. And so it's interesting that he's even made his way into the homeschool crowd. And your public schools are going to teach the same thing. Like, I can't say Haley learned a lot because she just did not like the teacher.
That probably doesn't help.
No, it does not. All right.
Okay, so this next one I have, it's written for the layman, not for financial advisors, but all life insurance agents should be thoroughly knowledgeable of its content and practice. Again, unfortunately, this is not the case. I have a client right now who, ironically, he's a farmer. I don't know how that happened. But he is. And he heard about this concept and he went to his life insurance agent and he was like, yeah, like, can I do infinite banking? And he's like, no, it's not possible. He had a UL policy. The agent didn't know what he was doing. So even if someone is a life insurance agent, that doesn't mean that they have the knowledge or the strategy to really help you out with this. And so that's why it's really important to know, to work with someone that knows what they're doing.
But when he says it's written for the layman, not for financial advisors, what he's saying is this book is written for the average person. Even though Nelson's conception of what the average person knows is a little different than what the average person knows.
I was like, I wouldn't say layman.
Apparently, Nelson's level and our level is not the same. Because I was not the layman when I was reading this. But he very much is saying, hey, I wrote this book for the people. And the people are going to have to go find the agent. The thing that everybody is hearing are the agents talking about it because now we're vocal and trying to teach it. But when you go to your average agent, they're not going to know, but you know because you've read the book. So you're now the expert over them. And I think a lot of people don't understand that either. Like you're asking all these people around you questions and they have never actually read the book. So how is that helping?
Yeah, maybe you should teach the agent that you have. You should get them the book.
And here's my thing. If the agent that you have, if the banker that you have does not, if the accountant that you have does not go out and buy the book on their own and read it, you should probably fire them. So if the banker, and I've seen this a lot too, oh, my accountant doesn't understand this, so I gave them my book. I'm like, why'd you give them your book? They should have said, no, I don't want your book. I will go buy the book and read it myself. When my clients bring something to me and they have no idea, I don't know what it is, I'm like, oh, where's that information? I'll go get it, right? Like, what's that book? I'll order it. I'll have it here in a couple of days. I'll read it. I'll look into it. I'm going to educate myself on it. It's just mind-blowing to me. They're like, oh, no, you can't do that. Like this agent, oh, no, you can't do that. But not where's the book? Have you read the book? Do you know the book? Like,
I think when people come across something that they're unfamiliar with or they don't feel confident in the idea, instead of like being curious, which I think is like our innate reaction to something, their brain just goes, no, not possible, because that's easier. It is easier to just be like, no. Instead of being like, well, how is it possible? Or how can I learn
It is
about
easier,
it?
but how does that make you better at your job?
Oh, it doesn't. But so many people.
And these people are trusting you.
Yeah. So I think you have the responsibility and duty to check it out on behalf of.
You should have the responsibility.
Yeah.
All right. The fifth paragraph, the whole idea is to recapture interest that one is paying to banks and finance companies for their major items that we need during our lifetime, such as automobiles, appliances, education, homes, improved investment opportunities, business equipment. This, I can't hammer this enough. This is about major items. This is not about buying coffee and running every single McDonald's French fry through your policy. Like, that's craziness, in my opinion. Major items, vehicles, appliances, like, set your limit, right? Some people say, oh, it's $1,000. If it's over $1,000, I'm going to borrow against my life insurance policy. Mine is not $1,000. And so this is a little bit subjective too, depending on who you are and how much money you make and all that kind of stuff. But there's a lot of agents out there saying, oh, Nelson said to put every dollar through a policy. He said major items.
Major items. Well, and I like this where he says the whole idea is to recapture the interest that one is paying to banks and finance companies. Like, this is money you are already happily giving someone else. So this whole idea is give it to yourself.
But this is a little misleading as well.
A little bit, yeah.
So let's clarify that.
Okay.
If we're not recapturing every dollar of interest.
Correct.
Because the insurance company is going to charge 5%-ish. What Nelson is saying is if you're giving them 10 or 15 or 7, you should still pay back at 7, 10, or 15. And anything over what the insurance company is charging you, you're going to recapture because it's going back into your policy as a premium payment, not a loan repayment.
Right, as additional
and
premium.
So people read this and they think, oh, I'm making money taking a loan. No, you're not. You're not. And even the recapture of the extra interest is a forced savings account.
You're still paying additional premium.
Yes. I wish he would have not worded it that way.
Clarified it a little bit more.
Because people truly use that and say, oh, you're recapturing. Not really.
You're redirecting, and that's only if you're disciplined about it.
Exactly. That's a much better word. Redirecting the extra over what the insurance company is charging you. Yes. And you do have to be disciplined. 100%.
Yes. Okay. So this next line is one of my favorites. This book is not about investments of any kind. It is about how one finances the things of life, which can certainly include investments. It is not about rates of return. I love this section because I think so often in the financial world, all people are surrounded by is investments. What's my rate of return? What's my cash on cash return? What's my return? And it's like, no, we're talking about the process of banking.
Mm-hmm.
What are you doing right now? Where does your money reside right now that you need to use for major things? Is that a credit card? Is that your savings account? Like, we are talking about the process of banking, which everyone, for the most part, participates in.
And he says the process of banking goes on no matter what happens. It is a well-known fact that banks make more money during low interest rates than high interest rates. It goes on. You cannot buy anything without having a bank. I mean, okay, you could if you had cash. I get it. You guys are cash people. I'm sorry. But if you have a debit card, if you have a credit card, if you have a checking account, if you have a savings account, money is going to flow through that system. Even if you are cash, let's just think about that. Even if you are a cash buyer, somebody had to use the bank to get you the cash. You may have had to go into the bank to get the cash. There is no cash without a banking system.
It's like, where's the cash deposited then?
Right.
Like
even if you put it under your mattress,
right?
It's still when you give it to me, I go put it in my bank account, right? And then for me to give it back to you, I had to take it out of my bank account. Like, there's not a bankless system out there.
Mic drop.
It's about how one finances things in life, which can certainly include investments. I think that is it. When I read that, it finally came to me that Nelson is saying you can finance investments.
Mm-hmm.
So people say, well, I can't have a life insurance policy because I want to put money in a 401k. But you can, right? Because you can pay your premium, borrow against cash value, and invest that in an IRA if you want.
Mm-hmm.
And so this is an and asset. We get to put our money here and we get to go do other things with it. People think, oh, well, I can't do that because it's an or asset, which is what an IRA is, a 401k, a Roth, whatever. No, you can still use this to put it into your investment. I don't care if it's real estate. I don't care if it's an IRA. I don't care if it's a brokerage account. Does not matter to me. I had a guy I talked to this last week as well. And he's like, Mary Jo, I'm going to come into like a boatload of money. And he's like, so I can get a better return outside the policy. But it would be smart for me to run it through the policy, right? And then borrow against the policy and go put it in my investment. I'm like, yeah. Because if you run it through the policy, we create a death benefit. That death benefit is massive. For what he's doing, the death benefit is super important because then if he dies, it goes back into this huge conglomerate of business opportunity that he's doing. Fantastic. Now he just made that opportunity bigger for his family.
Yeah.
And we don't think about that. We just are like, okay, well, it has to go here or it has to go here.
Right. It's like, that's not the same kind of thought process you have when you think about when you're depositing your money into just like your regular checking account.
Mm-hmm.
Because it's there to be deployed for something.
Mm-hmm.
Same thing with the policy. It's like you want to have it there to go deploy it for something.
Right. Yep. Okay. The next paragraph, this one's pretty simple. Most illustrations were developed in 2000 and people are saying, hey, well, the dividend scale was different. And Nelson is just saying the dividend scales are lower now. The difference in results remains the same. Nelson used to say all the time, it's all relative. Doesn't matter. It's all relative. All relative. All relative. It's all relative. It does not matter. The dividends were higher. Yes. Were they higher? Yeah. Does it still work? Yes, it still works. So it ultimately doesn't matter. But when people will ask that question, well, it worked then. Does it work now? Yeah, it works.
Been around for a long time.
200 years.
200 years. Okay, this one is, it's not a procedure to get rich quickly. To the contrary, it requires long-range planning. I love that line because I think so often, especially in today's society, like everyone is all about immediate gratification. It's like, I want that thing right now. What's the immediate return? And if you think about how great your need is for financing or for access to cash, that is a lifelong journey. So this is a long-term solution to a long-term problem, which is access to capital. So I really love this idea of it requires the long-range planning. Like you have to be okay with the fact that this is not a get-rich-quick thing. This is a
get rich slow.
Yeah, get rich slow. With certainty, guaranteed.
It's going to take generations, maybe. It's called generational wealth.
Right.
You know, like it truly is. People think, well, I don't have access to all my money right away. You don't have access to any of it in your 401k and IRA. What are you complaining about? You put money in a Roth, you wait till you're 59 and a half, but you want access to this immediately. As we go through this, we're going to find out Nelson was a forester. You must think long range. And the power of uninterrupted compounding is massive in the last 25 years of the policy compared to the first 25 years of the policy. Does it work for older people that are 55, 60, 65? Yeah, it does. 70? Yes, but we don't have that power of compounding. Me at 51, I do not have that power of compounding that I had when I first learned about this in my 30s. And so, but it still works. It's not like I'm not buying policies because now the death benefit and the generational wealth piece becomes equally as important. Becoming your own banker is not a tax qualified idea of any sort. The income tax law as we know it today has only been around since 1913. Life insurance has been around for over 200 years. It's nothing more than like-minded people contracting with one another to solve financial problems. That's also another one that I think is kind of funny is a lot of people use the tax piece of this and say, oh, well, this is how we're going to screw the government and not pay taxes. No. Like, it's always been an advantage. Nobody's getting screwed out of something over here. It's just a matter of, hey, this is how the tax code works. And so we're going to use it to our advantage. Life insurance is an income tax-free death benefit. It grows income tax-free if you borrow against it. You cannot take out over what you put in, your basis. You cannot take that out. Any gains cannot be taken out income tax-free. And so you have to understand how to use the tool and not just assume that's how it goes. Because I've had accountants over the years. They're like, this doesn't work. I tried it. You took it out.
Okay.
That is not the same as borrowing.
Right.
Stick to what you were trained in, perhaps, like taxes. But now you're telling people it doesn't work when in fact, yeah, it does work. You just have to understand it. And you obviously didn't study it. So, and he had a universal life. So there's that.
Boo.
Yeah. But I think that we also need to understand here that Nelson said there's nothing more than like-minded people contracting with one another. And what he's saying is, I hate the government. And so this is a good way to keep the government out of your business. Because Nelson did not like the government. And as we go through the book, or as you've gone through the book, you're going to see that he did not like the government. And so for him, he's saying, hey, if you buy a life insurance policy, we keep their fingers out of our dollars and they can't turn money through central banking. And so let's use the life insurance companies to borrow and pay back. And so that we're not making payments back to a bank who can then go get 10 times the money. So that's why that piece, a lot of people may think, oh, well, big deal. It's a private. Yeah, it's private. So you don't have, the other thing is you don't have creditors. So nobody's reporting to the credit bureau if you're paying loans back or not. Nobody is there telling you what you have to do. It is a 100% private contract. Nobody is reporting to the banks that say, hey, you have a loan. And so this comes up a lot for me. Well, Mary Jo, do I tell the bank that I have this life insurance policy? Well, I guess if you're going to get a loan, it's up to you. I tell my banker because all my money is there. And so I'm going to look like I don't have any money, right? But my banker also understands that I don't have to pay this back. And so if you have a banker that does not understand, then we might have a problem. And the banker might give you a hard time.
Well, and if you think about just like the longevity of that, it's like when you really understand this on an individual, family, business level, it's like all of that income, like all of that cash value and eventually that income tax-free death benefit stays private, hopefully. Like you hope that that's exactly what happens long term.
Yeah. Which is family teaching, which we then need to teach family if we want that to stay private.
Right. So you have a responsibility, people.
Yes.
Okay, the next one is wealth must reside somewhere. What better place to have it reside than here? From this residence, one can do anything that one can conceive. This is an advantage that most folks ignore in their thought process and therefore limits their effectiveness. I really like this idea because it really encourages me to ask people, like, where is the primary residence for your money right now? And what do you like about it? What do you not like about it? How is it serving you in your goals and your business and your financial world? Or is it not? But so many people are so busy that they don't take the time to actually think critically about what they're doing and why, because this has just been something that has been so normalized that we don't think about why. Why are we doing this?
And the consequences. That's another thing that we don't think about is where we're housing our money now and what are the consequences of that. How much control have we given up? What does that look like? Will they give us access to that money when we need access to that money? And a lot of times we have no problem. We're like, oh, we went to the bank and they gave us some cookies. It's fantastic. I love them, people. Yeah, I love my cookies too at the bank. But, and they're nice until they're not. And so where are we housing that money?
Which is, what did we look up yesterday about the HELOCs? That was so interesting.
Well, on a HELOC, I didn't realize that they can call those. So if you have a loan, this is what AI said. If you have a loan on a HELOC, through a HELOC, they can just call that note whenever they want. I don't know that they can call a mortgage necessarily whenever they want, but they apparently can call a HELOC. I thought that they could just shut HELOCs down if you were not using them. But you know somebody that in 2008 or 2009, their HELOCs got called and they lost everything because they were in real estate.
They lost the majority of their real estate because the rule of thumb is that if the home values go below what the HELOC is for, right? Because the line of credit is predicated on the idea that your property value is worth X amount. So then if it's not, then they don't have to give you the line of credit. And this guy thought he was doing infinite banking, but with his lines of credit. So he just was like putting money back on his line of credit, paying it back. And then 2008 happened and home prices went down. And so they called those lines of credit due and he lost the majority of his real estate portfolio because he did not have full control over his residence, where he was putting the money.
And a horrible time to be losing your real estate when there's no housing market. So you sell it and you're forcing a sale at a downturn. So you're truly going to lose money. So they're there when times are good, but they're not there when times are bad. And I feel like the farmers I work with get that because they've seen it over and over and over and over and over for generations. People outside of that world or outside of business, just your people that have a 9-to-5 job and, they want a real estate piece here and a real estate piece there. They're not going to experience that hurt because they're not in it enough. But if you're a business owner, the bank is nice to you until they're not. It's just kind of how it is. And I understand that because the banks are in a business. And their business that's just what they chose. Okay, let me make this abundantly clear. I'm not talking about a bank in the conventional sense of the word. I am demonstrating that one can use dividend-paying whole life insurance to solve one's needs for finance throughout their life. Yes, you still need a bank to deposit your money and to pay your premium and to get your cash value paid back. Yes.
Yeah, that's a common question. Well, do I even need a bank account? Yes.
Yeah.
You still need one.
Yes.
It's just your primary residence of the majority of your capital should change to your policy.
Yep.
Okay, so this next one is study the illustrations carefully and you'll see that very high premium dividend paying whole life insurance is the ultimate vehicle to produce such income. So the beginning part is, and I know, we like to not say the word retirement, but hopefully this book will give you a new perspective on the idea of retirement. I prefer to use the words passive income. That is money coming in that you can count on and you don't have to do anything to earn it at that time.
Mm-hmm. And so basically what he's saying is you're not going to have any money for retirement. If you put peanuts in, you're going to get peanuts out. It's no different than a 401k or an IRA. If you put $3,000 a year in, you're not retiring. And so you are going to need to fund these if you are going to retire and you want this passive income for retirement that's income tax free, you're going to have to load this sucker up now. And so putting in a tiny little bit of money is not going to work.
Well, it's also not going to solve your need for finance.
Right.
So,
he also says this will require several thorough readings for a full understanding. The concept is not complicated. It is just different from the way the majority think. In fact, it is the ultimate in simplicity. It definitely is not complicated, but it takes a long time to kind of get your mindset there, but you have to be open-minded. And then in the next paragraph, he says it again, education is an ongoing process. Read it, last paragraph, read it with an open mind, and you will discover a whole new financial world. And I think that what happens is a lot of people don't read it with an open mind. They see that it says whole life insurance, they close it up, and they never come back to it. And I hear that a lot. Like, oh, I was just not open to this until X, Y, and Z. And so I think that we really, people need to understand that just because it's new to you doesn't mean it's new. I mean, it's like saying iPhones are terrible. Smartphones are absolutely terrible. And so I saw a guy last weekend walking around with a flip phone. And I just started to laugh because I was like, he clearly doesn't like technology. And the guy was like 55, probably 55 to 60 years old. I'm like, dude, you have a long time to live to not just accept it and move on. Like, you're going to get left behind. Okay, that was that chapter. That was long. So I think we're going to break this up and be done with this one, and then we'll come back and do the next one.
All right.
Okay, we'll see you in the next podcast.